When startup companies are ready to take things to the next level, access to capital is critical to their success. In fact, lack of capital is one of the primary reasons businesses fail. Many entrepreneurs cultivate relationships with leading venture capital firms to secure an early funding source and grow responsibly. One of the most persistent challenges for a startup is to adequately capitalize the business from the inception of the company until profitability. Most startup companies have a negative cash flow over a long period of time before they achieve a positive net income. Venture debt, also known as venture lending, is a smart financing option that complements venture capital and provides significant value to fast-growing companies and their investors. Progressively, the business is rewarded for achieving major milestones by an increase in company valuation. Over time, most companies require multiple infusions of venture capital to expand. So, the optimal time to raise funds is immediately following one of these valuation drivers, resulting in less equity dilution for the same amount of capital raised. Let's explore 3 primary uses of venture debt that illustrate the value to growing startup companies and their venture capital investors. Number 1. Venture debt can extend the cash runway of a startup company to the next valuation driver. In this example, the company could raise a smaller Series B and then leverage venture debt to ensure Series C is raised at a higher valuation. Management and employees would benefit from less dilution due to smaller equity raises. Existing investors would also benefit from less equity dilution or less cash required to maintain their ownership position. Number 2. Venture debt can extend the runway of a company to be cash flow positive. In this example, the company can leverage venture debt to completely eliminate their last round of equity financing. This is a great use of debt as it reduces equity dilution for both employees and current investors and propels the company forward during a critical period of growth. Number 3. Venture debt can serve as a cushion for what can go wrong. What if your first set of customers who were supposed to sign this year slip out to next year? You don't have enough cash to last until then. You still need to raise your Series C financing, but now it won't be at that higher valuation. In fact, because you missed your plan, it will likely be a penalizing down round. Venture debt could have helped bridge this gap until the company is back on track. Let's explore 2 final examples that illustrate the value of venture debt to founders and employees of growing startup companies and their venture capital investors. Let's look at a company that plans to raise $15 million in Series A to develop their product, $27 million in Series B to develop their marketing and sales channels, and $20 million of growth capital in Series C once they sign their first set of customers. At first, this company plans to capitalize their business with equity only, without any venture debt. If the company raises each round as planned, at the end of their Series C financing, the founders and employees would own 37% of the company, and the Series A investors would own 25%. This assumes Series A investors do not invest pro rata in future rounds. If the same company could plan a smaller venture debt round after each equity financing, they could raise less equity overall while still providing the business with more capital and a longer runway during each raise. But more importantly, they could benefit from less equity dilution. By layering in smart debt along the way, the founders and employees would own 47% of the company after Series C, and the Series A investors would own 32%. That's 17% more ownership for employees and investors due to venture debt. If the company grows to be valued at over $1 billion someday, that's over $170 million worth of value. Venture debt is a smart and critical source of capital for today's entrepreneurial companies. As a complement to equity financing, venture debt provides growth capital to extend the cash runway of a startup company in order to achieve the next milestone while minimizing equity dilution for both employees and investors. Trinity Capital Investment is a leading provider of venture debt financing. For more information, please visit our website at www.trincapinvestment.com.